Hey everyone, welcome to the show. My name is Sam Shaw and I'm the founder of Wall Street Mastermind. This is Wall Street Mastermind's Elevate program, where we take our flagship coaching program and give it away for free to high potential students who are currently in a difficult financial situation. The goal of this show is to first and foremost give these students the coaching and guidance that they wouldn't be able to get otherwise and help them break into investment banking. Of course, we also want to give all of you an in-depth look at how to go about your own investment banking preparation process the right way, so that you can model it after the same proven methodology and strategies that we've used to place over 90% of our students into investment banking across every single bulge bracket and elite boutique bank over the last several years. With hundreds of thousands of applicants competing to break into investment banking globally each year, our team only has the bandwidth to help a very small percentage of you. So my hope is that this show helps all of you, even if you aren't able to directly participate in our program and work with us. So let's get to it. In this session, we briefly walk Ximena through the difference in approach for target school and non-target school recruiting. We then spend the majority of our session going through different DCF concepts in detail. We cover topics like terminal value, working capital calculations, WACC, and beta, just to name a few. The DCF is one of the most popular topics for interviewers to ask about, so it's important to learn these concepts well. All right, so back with another session for Ximena. We are, I guess, talking about today another update on the diversity programs and also going over some of the DCF stuff, right? Is that what's on the agenda?
Yep.
Cool, awesome. So what's going on? You want to start with the diversity stuff maybe, or?
Yeah. I just kind of had a couple questions. So for diversity programs and everything, I kind of asked you before through Slack, but then I applied for a couple of diversity programs, and I just wanted to clarify, like, some of these, it's just an advancement to the super day, right? It's just like I had a diversity women's like interview, but it was like exactly like kind of I think what a super day would be like, or the ones that I've had, where they asked me like, tell me something about the news, why Perella, tell me like something, a deal that's going on, something like we worked on, and then they gave me a bunch of behavioral questions, so it just felt very like an interview. So I was just confused if it's an advancement to a super day or how that kind of works.
This was an interview for their diversity event, right?
Their women's event, yeah.
Yeah. And their women's event is what, like a 2-day event?
Yeah.
Okay. Yeah, I mean, different firms do it differently, but I think a lot of firms, like if you go to the event and they like you, then you'll just pretty much be guaranteed like an interview for the junior summer internship. But you still have to interview again for the junior internship, right? Some events they have, I've known some events where they have like an interview at the end of the event, and then that's the interview that determine whether you get fast tracked to the junior summer process. And so I'm just not sure how Perella specifically does it, but
Okay.
either one is possible, I think.
Okay.
Yeah.
Okay. That was that. And then okay, and then
yeah. Back from that one?
Yes. They said, yeah, I can't remember how long they said. I think they said they'd get back to us at the end of January or at the beginning of February. So I'll hear back from that.
Okay.
But even like the person that interviewed wasn't somebody at Perella. It was like another company that works with Perella.
Mm-hmm. Mm-hmm.
So yeah.
Okay.
It was just very complex. But that was that. And then something I kept asking you about this on Slack, but I feel like I wasn't writing it well, where I was asking you about like recruiters from your school. So in terms of like when you're networking and the fact that they might have a big say from your school, I don't know if you know, like, how does that process work? And like are they I don't know, do they have to recruit people from their school? Like, is it somebody that you should kind of see as like a team player to kind of like help you like from your school, or does the conversation vary in any way than any kind of networking call that you do?
I think the way to think about it is like if you're a target school student, which I would consider your school to be a target school, but like a lot of target schools, they will have their own like recruiting team inside of the firm. and that recruiting team will consist of alumni from that school, right? And so these are like bankers that went to your school and now work at the bank. And then usually like each recruiting team, like the NYU recruiting team, like there's also going to be like a recruiting captain, and then there's like other people, and they're like responsible for screening the candidates from their school. And the reason why they do that is because since they went to the school, they're going to be more familiar with like just both like in terms of like the extracurriculars that are available at that school, like, oh, this person's in this club and that's a really hard club to get into, or, you know, oh, this person like took this class or majored in this and their GPA is maybe slightly lower, but it's because, you know, this major is notoriously difficult or whatever, right? Like they have more context for the school specific information.
Okay.
And so the idea is that they should theoretically be able to make a better judgment call on like, you know, who the best candidates are, right? And so like if there is someone who's, if you meet someone who you know is on like the NYU recruiting team for that bank, then yeah, those are like probably some of the most important people for you to network with, because they can, I mean, they can single-handedly decide if you have a shot to interview or not, to be honest.
Mm.
So
Okay.
that's, does that make sense? Like if you, because like
Yeah.
otherwise if you go to a non-target school, then you probably won't have a team like that. And then it's like, then you just have to network with everybody.
Yeah.
Right?
Okay.
Or what I tell the non-target people to do is like try to network with other bankers at that firm that also came from non-target schools, because if they came from a target school, they might be more inclined to just help the people from their school.
Yeah.
If they came from a non-target school, there's not as many people reaching out to them, and you're also a non-target student. So just, it's, the approach is a little bit different.
Okay. Thank you.
Sure. But in terms of like, you know, the conversations that you have with them, like, I don't think it's really any different. You know, it's the same framework that you typically use in terms of the types of questions that you ask. If anything, the only thing that would be different, I think, is like you probably have more in common with these people. You know, you can talk about NYU related stuff and be able to relate.
Mhm.
So it's easier to, if anything, it's easier to just like break the ice and stuff.
Okay.
But other than that, I don't think there's that big of a difference.
Okay. Thank you. Yeah, I just wasn't too sure what the target school thing was. Okay.
Yeah, sure. Okay. Any other questions about this part?
I don't think so.
Okay. So you had like some questions on the DCF?
Yeah. I was wondering if you could go through the Gordon growth method or the perpetuity growth method for the terminal value.
Yeah. What about it?
I don't really understand like the use of the ratios, like 1 plus G and then WACC minus G. Just like conceptually.
Like why the formula is the way it is?
Yeah, I don't understand. Like, is it something I should just memorize, or is it like a why question? I don't really understand the ratios.
There's definitely like an academic theory behind why the formula is what it is, right? To be completely honest, like I don't think you need to know it. Like
Okay.
I can't I can't like do the proof, like the mathematical proof for like why the formula is what it is.
Yeah.
I
Yeah.
couldn't tell you. That's one of those things where you just kind of like memorize the formula.
Okay.
But conceptually, I think it's more important to be able to like explain conceptually what that thing is, like what it's supposed to represent,
Yep.
versus like why is the formula this, right?
Mhm.
Yeah, you can memorize the formula too, but I think nowadays it's like it's very rare. I don't want to say rare, but I think more and more it's becoming more and more rare where the interviewer just asks you for like a definition like the definitional type questions where they're just like, hey, what's the formula for Gordon growth? It's like, because that's honestly a bad question, because there's a lot of people that just memorize these formulas, but they have no idea.
Yeah.
So like bankers know, most bankers know, like, okay, let's ask better questions, right? I think like conceptually though, what the Gordon growth terminal value is supposed to represent is just that you project out the DCF for the first 5 to 10 years, usually either 5 years or 10 years, because beyond that, like if you told me to project out further, like it's just not realistic. Like I don't know what the company is going to grow at every single year. I don't know what the margin structure is going to be. I don't know how much you're going to spend on capex, working capital, all these things. Like it's a lot of variables that you have to input into the model, right? And so the further out you go, the harder it becomes to project, and the more it becomes just like fuzzy math, right? It's like garbage in, garbage out. And so,
Right.
so for anything beyond the first 5 to 10 years, what the Gordon growth method is doing is saying, let's just assume that all the future cash flows beyond the first 5 to 10 years, because there will continue to be future cash flows, even though you're not projecting it, right? They're basically like taking a shortcut and just like swagging it and just say, okay, we're just gonna like back of the envelope. If we take a swag, like let's just grow last year's cash flow at a certain growth rate, and we'll just like grow that into perpetuity, like grow that by that amount every year into like eternity, basically.
Yeah.
Right?
Mm-hmm.
And that growth rate that you choose is typically going to be something that's like very close to GDP growth.
Okay.
But it shouldn't be greater than GDP growth.
Mm-hmm. Right.
Because it can't, if it's greater than GDP growth, then by definition, if it's growing into perpetuity, eventually it'll make up the entire GDP, which doesn't make sense, right? Yeah. So usually like that growth rate would be like slightly less than GDP growth, and GDP growth, I don't know what the long-term average is. I was like, usually it's probably like, I don't know, 3% or something, right? Mm-hmm. And I think the denominator, the reason why there's like WACC minus like cost of goods sold, or not cost of goods, WACC minus like the growth rate or whatever. The WACC is like, if you think about the first 5 to 10 years of cash flow that you projected out, mm-hmm. you are discounting it against the WACC, mm-hmm. right? And so there's always WACC in the denominator. And so even for all of your future cash flow beyond the first 5 to 10 years, similarly, you got to have the WACC in the denominator, because you're still discounting back that last terminal value cash flow. Mm-hmm. Right? That's why that WACC is down there. But there's probably some mathematical proof that says like, because you're summing up every single year into perpetuity, then you can just do like WACC minus the growth rate or whatever, right? And okay. I haven't tried to work that out, but like I've never really been asked to do the math. So does that make sense though?
Yep. Yeah. But is there like a reason why, like, would they ask you why would you use a terminal multiple and not the Gordon growth method, or is just those are two ways to calculate the terminal value?
So for that, I would just say, you know, the Gordon growth method is kind of like the more academic way to go about it, right? It's like if you take a corporate finance class, that's kind of like how they would teach you to calculate the terminal value. Whereas like the exit multiple method, it's a bit more practical, right? Like in banking, a lot of times you are like, you're not trying to, like valuation is an art and not a science, right? You're not saying that whatever number you get to, it's like an exact precise number. Usually when you do valuation, you're saying like, hey, ballpark, I think like this is roughly approximately a reasonable range, right? And also in banking, because you need to do stuff very efficiently because you're usually so busy, you have so much work. So a lot of times like you're just looking for the fastest and most efficient way to do something that's still going to get you reasonably close. And then so like the exit multiple method is a lot easier to calculate than to say like, oh, let me go figure out like, oh, what's the growth rate and then like what's the WACC and like this and that, right? Like you just apply a multiple, slap it on there, and like it's easy, right? So that's why like from like a more practical standpoint, you would use the exit multiple. The more academically correct way, I guess, would be like the perpetuity growth. But in reality, like since both methodologies are available and neither of them are hard, what you do is like you just do both. You just run both, and then that way that allows you to like sanity check your assumptions, because if your perpetuity growth method and your terminal multiple method gets you very different terminal values, then you're gonna have to ask yourself like, why is that, right? Is it because like the terminal multiple that I'm, or the exit multiple I'm using is too high or too low? Or like what would the multiple have to be for my terminal value to be more closer together? Then they're never going to be exactly the same between the two methodologies, right? But like, how do I at least get into the buffer? Like what would the multiples have to be? Or on the other side, you can play with the growth rate that you're assuming to see like what does the growth rate have to be for you to match like the exit multiple method, right? And if it's like the term, this typically won't happen, but if it says like, hey, the perpetuity growth rate has to be 20% for the terminal value to be close to your exit multiple method, then like that's just not realistic. You're never going to have a perpetuity growth rate of 20%, right? And so it's more of a sanity check, because again, since it's an art and not a science, you can never be like overly confident that the number that you arrived at is the right number. And so you want to kind of like slice and dice in multiple different ways. And if it's all converging on kind of like in the same area, then that gives you more confidence, because you're kind of triangulating that, like, okay, no matter how I look at it, it's bringing me back to the same conclusion.
Yeah.
Right? The same thing why we do trading comps and precedent transactions and DCFs all together and then put it on a football field, because it's helping us triangulate like, oh, okay, like this is the range that kind of like intersects all of those different valuation ranges, right?
Okay.
Just triangulating.
Got it. Okay. I think about the Gordon growth. So on the model in the module, when you have the 2XL, when you have the XL, and on the Gordon growth, why is it that you go to year 11?
Because when you're doing the Gordon growth, you have to calculate the terminal value off of like you take the last year plus one. You need to do like one extra cash flow.
Yeah.
That one extra cash flow is like, that's the variable, that's the input to calculate like the terminal value that's supposed to represent all of your future cash flows that are grown into perpetuity. Whereas for your exit multiple method, like you don't have to do that. You can just calculate it off of the last year.
Okay.
Why is that? Again, there is a mathematical proof.
Okay.
Right?
Okay.
But I'm not able to explain. I don't think you have to either. But just know that, just know the difference and know that you have to do that. But I think like also, don't fall into the trap of like, if they ask you to explain the DCF, don't fall into the trap of like explaining these kinds of nitty-gritty details, because it's going to make your answer like just, it's correct, but it's too into the weeds.
Yeah.
A lot of times you're going to lose the banker and like, yeah, I didn't ask about that. Right.
Yeah.
So I would keep it high level.
Okay.
You know, just like you can even just say like, yeah, so you got to project out the first 5 to 10 years of free cash flow. And after that, you got to calculate the terminal value. For the terminal value, you can either use the exit multiple method or a perpetuity growth method. And then you discount all the free cash flows for the first 5 to 10 years back to present. And you also discount the terminal value back to present. You add those two things up. That gets you to your enterprise value. Like, keeping it very high level, and then they can drill down into it if they want. They can ask you follow-up questions like, oh, well, so what do you mean by perpetuity growth method? Or what do you mean by terminal, what do you mean by exit multiple method? What's the difference? How do you calculate it? Like, if they start asking these things, then you go and answer those. Right. So
Right. Yeah. And for the terminal multiple, again, you're comparing it's like comps with other companies' terminal values, right? Terminal multiple, sorry.
You mean, how do you find the multiple for that?
Yeah.
Yeah, you would just look at comps.
Yeah. So like, but you would have to like be hoping that other companies have done DCFs, right? And have used other terminal value multiples.
No, like you look at comps as in like literally just look at your trading comps.
Oh, trading comps. Okay. Okay.
You look at trading comps, it's like, okay, these are my comps. They're
Okay.
trading at, 5x EBITDA. So I'm going to use 5x EBITDA.
Okay.
Right? It's as simple as that.
Okay. Okay. I feel like I'm really specific on these. I think, yeah, I was just going through the whole thing. Okay.
Be specific, and that way you really understand it. Right.
Okay. Then there was another where it was like specifically on the Gordon growth model, you do the what is it called? The mid-year
Convention.
Yeah, and not on the terminal multiple. So why not?
Because on the mid-year convention, so we explained the mid-year convention last time, right?
Yeah.
So I think you understand. It was in like our 2 sessions ago. So you understand why we do the mid-year convention. It's like,
Yeah.
otherwise, if you don't do it, you're kind of assuming that your cash flow always happens on like December 31st of every year, which is just not realistic, right? The perpetuity growth method, that terminal value is supposed to represent like, it's almost like it's supposed to represent 1 extra year of cash flows, but it's taking all the future years and lumping it into like 1 gigantic year of cash flows. Right? So for the same reason why, if you're taking like that 11th year of cash flows, you got to move it back to the midpoint, or else you're just assuming that that entire cash flow is happening at the very end of the year, right?
Yeah, of the 10 years, of like every year on the 10th year.
No, because for the first 5 to 10 years, when you actually project out each year, you do the mid-year convention because you're assuming that the cash flow for each year is not just happening on the last day of the year. You're using the midpoint, so it's kind of like you're evenly spreading it out throughout the 365 days of the year, right? It's the same idea for that last extra cash flow, the terminal value cash flow, which is basically like the 11th year in your forecast, right? But like, we don't want to assume that if for the first 10 years of the forecast, you assume the cash flow happens on June 30th every year. You don't want the 11th year's cash flow to happen on December 31st. You want that to also happen in the middle of the year so that it's like evenly spread out, basically. Yeah. Does that make sense? Okay. Yeah. That's why we do that for the perpetuity growth method versus for the exit multiple method. The terminal value is not, the way you're deriving the terminal value is not off of like a cash flow it's not a free cash flow calculation anymore. Now you're actually just saying like, hey, instead of doing a DCF, it's almost like we're going to calculate the terminal multiple. Well, we're going to calculate the terminal value by using comps. Yeah. That's what you're doing, right? You're taking like the EBITDA multiple of your trading comps and you're applying it to like whatever the last year's EBITDA is, and you're saying, okay, then the enterprise value should be this. And so you're not going to do mid-year convention when you do comps, right? Yeah. When you do comps, you're just applying a multiple and then that's it. Yeah. Right. So it's almost like the exit multiple method, you're mixing and matching methodologies. Like the first 5 to 10 years, you're doing a DCF, and then like the last, like the rest of the cash flows that you can't project out, you're using comps. Yeah. Versus the perpetuity growth, you're doing a DCF throughout the entire thing. Makes sense. Yeah. Thanks. Yep. Next, so on the DCF, when you did the projections of the working capital, so that's like the one thing that's not a percent of revenue. So, but like you had very specific values. Is that
you normally don't have that. So how do you project working capital?
So for working capital, there's it's like the easy way, and then there's like the oh, by easy way I mean like shortcut way, I guess let's call it. And then there's also I guess like the more, I don't know, formal way to do it, which is like using working capital ratios.
Okay.
So the easy shortcut way is to just calculate changes in working capital as a percentage of revenue.
Okay.
Okay. So that's like pretty easy because you already have revenue, and then you just look at like the historical, the last 2 or 3 years, what has the changes in working capital been as a percentage of the revenue? And then if there's actually like a clear trend, then you can kind of like extrapolate that out, right? That's like very quick and easy. If you want to use like working capital ratios, then you what that is like there's days inventory outstanding, there's also days sales outstanding, and then there's days payable outstanding. Okay, so what that is essentially like days sales outstanding is conceptually is the average number of days that it takes your company to receive payment for something that you sold. So this is like how you project accounts receivables, right? Like what is accounts receivables? It's like you've sold the thing, but your customers still owe you money. So you have this asset that's recorded as a receivable. So if you want to project out accounts receivables, you could use day sales outstanding. And then same thing, if you want to project out inventory, days inventory outstanding is like how many days does it take for the inventory to get sold, right? Like by the time you acquire the inventory, how many days is it sitting on the shelf before someone will actually buy it?
Right.
So like, then there's like days payable outstanding, which is like how many days on average, it's the opposite of days sales outstanding, which is like how many days does it take for you on average to pay off your accounts payables? And so for things like days sales outstanding, you want that number to be as low as possible, because the lower the number, it means the quicker you are able to collect cash from your customers, right? Like if you sell something and you say, hey, you can either have your customer pay you in 30 days, or you can have your customer pay you in 60 days, or you can have your customers pay you in 90 days. Like, which one do you think is most favorable to you as a business? It's 30 days, right? Ideally, they pay you on the spot, so then it's like 0 days, right? So day sales outstanding measures like how long does it take for your customers to pay you? And this is all negotiated, by the way, right? Like at the company level, when companies sell something to another company, like they'll negotiate the terms. So they'll say like, oh, it's net 30 or net 60 or net 90, which just means like, this is how many days you have to pay us once we invoice you, right? And a lot of times, like how many days you agree to, it just depends on the negotiating leverage that both parties have, right? So what does that mean? Like, so we take Apple as an example. Apple makes a lot of iPhones, right? But Apple, to make an iPhone, they have a lot of suppliers that supply them with all the little different parts inside the iPhone. So like this company will provide like the camera that goes on the iPhone. This other company will provide like the memory. This other company will provide like, I don't know, some little chip that goes inside. Like there's all these different suppliers, right? And when Apple is negotiating terms with them, because Apple is such a huge customer, like typically, like Apple sells so many iPhones. For these semiconductor companies that are providing like the chips in the iPhone, like to win that business is like huge, right? Like Apple is probably their top customer. It's the biggest order they have. If they don't agree to the terms that Apple wants, Apple's just going to be like, well, I'm going to go to your competitor and they're going to offer us better terms. And then like, you're just going to lose our business. Right? And so usually in these situations, Apple's going to have the upper hand in terms of like negotiating leverage. So Apple can negotiate really, really favorable terms, right? Apple can say, okay, I'll buy this chip from you. I don't want to have to pay you for 90 days. Or I don't have to pay you for 180 days or whatever, right? Like basically like what that means is their suppliers are floating them money. Like their suppliers are giving them a interest-free loan, basically, is what it is.
Mm-hmm.
Right? On the other hand, like when Apple's customers buy an iPhone, what do they have to do? They have to pay everything up front. Mm-hmm. Right? And so Apple is collecting money on day zero, but they're not having to pay for these products that they're selling until way later. And so that means that they're going to have more cash on hand that they can then invest back into the business. Mm-hmm. That's what working capital means, right? Mm-hmm. That usually will create a positive cash flow for them, mm-hmm. right? That's the idea of working capital, is like conceptually, that's what you're calculating, is like how long is it taking for money to come into the company, and then how long does the company have before they have to pay other people? Like on the payable side, like same thing. Like if Apple, actually what we just talked about is like a payable, right? Like they're buying from suppliers, so their days payable is really, really high, mm-hmm. right? But looking at their suppliers' point of view, like their suppliers' days receivables is really high, because their suppliers' days receivables is the same as Apple's days payable, right? Those two things are the same, two sides of the same coin. Mm-hmm. Right? Does that make sense?
Yep.
And then days inventory outstanding is just like, okay, so Apple, as soon as Apple puts this iPhone on the shelf, like how many days is it taking them to actually sell these iPhones, right? And like these iPhones sell like hotcakes, so the days inventory outstanding is usually going to be pretty low, right? Mm-hmm. So as a company, you want days receivables outstanding to be low. That means you're collecting money faster from your customers. You want days inventory outstanding to be low. That means that you're selling out like very quickly and having to replenish. And you want days payable outstanding to be high. Mm-hmm. If it's high, then that means that you can take longer to pay your customers, or to pay your suppliers, right? Yeah. So that's the first thing to understand, is like, it's the concepts behind these ratios. And then like, so if we take any of these, so they all have formulas, right? Oh, my Apple Pen is not working. I'll probably have to charge it. Okay, I'm just going to use my finger for now. So like, for example, days payable outstanding, also known as DPO. Okay. The way to calculate this is it's accounts payable times number of days divided by the cost of goods sold. Okay. So then like, if you were trying to forecast, what you're trying to forecast right now is actually the accounts payable line item, right? So if you have the cost of goods sold, right? Well, first of all, actually, for the historical, you're trying to project this for future periods. Mm-hmm. But for the historical periods, you're gonna have all three of these things, right? Like let's say for last year, let's say that, I don't know, I'm gonna make this up. Let's say you say the accounts payable was 100 last year. Okay, and then last year had 365 days, right? And then let's say like, I don't know, the cost of goods sold was 1,000. Okay, that means that your days payable outstanding is what? 100 times 365 divided by 1,000, so that's 36.5. Okay, so what this is telling you is, based on our historicals, on average, it's taking our company 36 days and a half to pay our suppliers the money that we owe them. Mm-hmm. You can calculate this for every single historical period. So let's say like we do 2019, 2020, 2021, and we say like, okay, last year was 36.5 days, right? Let's say the year before that was slightly higher, is 38. This is going to fluctuate, you know? And let's say the year before that it was 37. Okay. And now you're trying to project 2022, right? It's a question mark. Oops. Then what you can essentially do is you can say, okay, well, it's 37, 38, 36.5. So I'm gonna just assume like the average of this is about what, 37, let's just call it. Yeah, it's probably like slightly lower than that, right? So let's just say, okay, but it's around that, right? So let's just say, let's just pretend if we were to project out what the days payable outstanding is for 2022, it's also going to be around 37. Okay. Now, for 2022, you're going to also have the number of days in the period, which is going to be 365, right? Oops. And then you're also going to know what the cost of goods sold is.
Mhm.
Let's pretend like the 2022 cost of goods sold is actually $1,200 because you've already projected that on the income statement. Well, now it's just algebra, right? You're just saying days payable outstanding 37 equals accounts payable times 365 divided by 1,200, and then you can rearrange everything to isolate the accounts payable, right? So basically it's 37. So I can move the 1,200 over here to the other side, right? So it's going to be 37 times 1,200 divided by the 365 equals accounts payable. This is just basic algebra. So then 37 times 1,200 divided by 365 gets me to 121.6. Okay, running out of space there, but let's just call it 122. So now I just projected the 2022 accounts payable is going to be 122, right? We know 2021 was 100 and 2022 was 122, so accounts payable went up slightly.
Mm-hmm.
You can just repeat this process for 2023, 2024, 2025. Now, I just showed you how to do this for accounts payable.
Mm-hmm.
There's a separate formula for days receivable outstanding or days sales outstanding and days inventory outstanding, which are like very similar actually, right? So like, for example, days inventory outstanding is actually just DIO equals inventory times number of days divided by cost of goods sold. Right? You see how it's very similar, except we're changing accounts payable for inventory here, and the other two parts are the same. So again, you can use the exact same methodology. Look at the historical year. What was the DIO? Extrapolate that forward, do the algebra, and then back into the inventory balance, right? And then for days sales outstanding, this one's again very similar, but the only difference is, so this is for accounts receivable. So you do accounts receivable times number of days divided by, this time you're divided by sales instead of COGS. Mm-hmm. So days inventory and days payable outstanding have COGS in the denominator. And then days sales outstanding has revenue in the denominator, because the idea is that if you're doing inventory is more driven by COGS, right? Mm-hmm. And same thing with payables, it's more driven by COGS, whereas for sales for receivables, that's more tied to your sales, right? Because it's like, how long is it going to take for you to collect? So it's all like very similar formulas. You use the same methodology, but you plug in the different inputs, and then you can back into each of those line items. And then once you have the line items, now we just projected accounts payable, we projected inventory, and we project the accounts receivables, right? Now you can calculate the working capital balance in each year. And then the change in the working capital is what affects your free cash flow, right? Does that make sense?
Yep.
So for these three are like the main working capital line items, by the way. And so they have like their own formula for like the work days outstanding. A lot of the working capital line items, a lot of times like you don't have these ratios, and in that case, you're just going to do it as a percentage of sales.
Okay.
You can project as a percentage of sales, or sometimes, depending on what the line item is, you might project it as like a percentage of some other line item on the income statement. It could be like percentage of OpEx. Like for example, it's like you're trying to project out prepaid expenses. It's like you're not going to tie that. You might not tie that to sales. You might say it makes more sense to take that as a percentage of our overall operating expenditure, because what we're saying is like what percentage of our OpEx it was prepaid, right? Does that make sense?
Yep.
So that's how you do it. You project out every single line item under current assets and current liabilities. Then current assets minus current liabilities equals working capital. Then the change in the working capital from one year to the next, it gives you the cash flow impact that you need to factor into your free cash flow calculation.
Okay.
Does that make sense?
Yep. Thank you.
Sure.
Okay. Yes, I got it. Okay. Oh, maybe just okay. So I have a general question, just kind of I want to just walk through it. So I understand the importance of the discount rate and everything, like to discount it back. But okay, so I think there's like two different ways to so one is like to discount it back to like the present day net value, like the future cash flows. But then like going into like in depth of like the discount rate of like how it's like the cost of the total capital. What I didn't really understand was like when you were talking about how it's what you're kind of giving up, like I don't know if I'm saying it right, but it's like kind of like what you could have done with the money if you weren't investing it in the company. So that's what makes it have a higher risk. And then you have the riskier the company, the higher the discount rate.
Okay. So, sorry, was that a statement or a question?
So it was kind of both, but so my my question was if you could like explain it to me in a way that I don't think I was understanding it well. I understand the fact that you have to discount it back because of the value, the time value of money. I don't know if I said that right, but
what is the weighted average cost of capital supposed to represent?
Yeah, the way that like you talk about how it's like, yeah, what people are giving up if they're investing in your company. Yeah, I just didn't really understand. Like, could you re-explain it?
Yeah, so basically like, because what you're doing is if your investors give you money, right? Like, so if a company needs money, they can go out and raise it one of two ways. Like you can either sell equity, which is a percentage of business, to your investors. So you give them your equity, like I'll give you 10% of my company in exchange for X dollars, right? Or if I don't want to give up ownership of my business, then I can borrow the money, right? And I can go take on debt, which means I have to pay it back, right? Now, when your investors give you money, they're giving you money to like earn a return on their money that they're giving you, right? And so your investors are never going to, like, the reason why they would give you money is because they think that, they would get a certain amount of returns by investing in your company as opposed to investing it elsewhere, right? And so when we discount back the future cash flow of the business, we have to figure out like, okay, we know we have to discount it back. But like, how much should we discount the cash flow back by? Like, what is that discount rate, right? Because I'll put it this way: it's like, if I asked you, I said, hey, Ximena, like, I'll give you $100 today or $100 tomorrow. What would you rather have? You're gonna say you would rather have $100 today, right? Or let's not say tomorrow. Tomorrow's too soon. Let's say it's $100 today or $100 a year from now. You would say I would rather have $100 today. Why would you rather have $100 today? Because if you get $100 today, you can go and invest $100 and grow it so that a year from now you would have more than $100. So that's why $100 today is worth more than $100 a year from now. Right? Now, okay, and the reason is because you can go and invest this and earn a return for a year. Well, the question is, like, if you were to go and invest this, what percent return would you get? Like, what are the alternatives that you have? If you didn't give me your money today and you invested, you want to invest elsewhere, like, let's say if you felt like you could have gotten 10%, right? Then that means that a year from now, you would have to give me you have to offer me at least $110 for me to even consider taking your money a year from now instead of today. Now, if I say, hey, Ximena, I'll give you $110 in a year or $100 today, which one would you rather have? Now you actually have to think about it, because it's like, okay, well, if I take the $100 today and I grow it, I can only grow it to 110. So it's like, okay, that's breaking even, right? But if I told you, actually, I'll give you 120 a year from now. If you're only able to invest this $100 and get 10% on it, now you're saying, hey, I would rather get 120 a year from now because that's better than what I could do on my own. Right?
Yep.
So far. So in this case, this 10% becomes the discount rate, becomes like the cost of capital, because that's like your opportunity cost, right? As an investor, you, the investor, should know that's your opportunity cost for giving your money to this company. Because if you don't give this company your money, you can go somewhere else and earn 10%. Okay? So what the weighted average cost of capital is you have two types of investors. You have equity investors and you have debt investors, right? And I say your equity investors, they have an opportunity cost, which is the cost of equity, right? Your debt investors, they have an opportunity cost, which is like the cost of debt, right? And then you're just taking like the weighted average between the two, depending on how much of your capital came from equity investors versus debt investors, right? Let's say it's like 80% came from equity holders and 20% came from debt holders. Then it would be 80-20, right? But also cost of debt has a tax shield, so you have to do also tax effective, right? So in other words, like your weighted average cost of capital is, you're just trying to calculate what is this opportunity cost for all of your investors as a whole. Like up here, we just did it for one person. We did it for Ximena. We did it for you, the individual investor. For the weighted average cost of capital, we're doing it for your entire investor base as a whole. What is their overall blended opportunity cost that they're foregoing by giving you their money instead?
Okay.
That's what we have to discount our future cash flow back against. Does that make sense?
Yeah.
In other words, it's also like, how much does it cost the company to raise money from equity and debt investors? Because like, how much does it cost? Like the cost of debt is like, how much interest would you have to pay these debt investors? Right? The riskier your company, the higher interest they're going to charge you.
Yeah.
right? But if you're like lower risk, like Apple, they can pay very low. They can probably pay like 1% interest or less because
Mhm.
know that Apple is not going to run out of cash. They're always going to be able to get paid back. It's almost just like free money,
Mhm.
right?
Yep.
And then equity investors, same thing. Like if you ask me to give you my money in exchange for a percentage of your business, the riskier your business is, the more likely it is that the money that I give you is going to end up being worth nothing someday.
Mhm.
So the higher the risk profile, the more returns I'm going to expect to like make up for that risk, right? I don't want to take more risk if I'm just getting like really, really low returns. I could just do that in like much safer investments,
Okay.
right? But if your company's pretty safe, like sure, I'll give you my money, like, but the return's not going to be as high either, right? This is like an immutable truth of, or like in theory in investing, it's like they say like high risk, high reward, low risk, low reward. Assuming the market is efficient, if there's an opportunity where it's low risk, high reward, then everyone will flock to it and want to invest in it, right? If everyone's investing in it, then like the returns are going to come down,
Yeah.
right? And if there's something that's high risk, low reward, then presumably no one will want to invest in it, right?
Yep.
They're like increase the rewards to incentivize people to invest in it, right?
Okay.
So this is like WACC is just like a representation of like how risky your business is, because the riskier your business is, the higher the cost of capital is going to have to be to incentivize these investors to give you their money.
Right.
The lower risk your company is, the lower your WACC can be, because it's going to be easier for you to raise money, whether it's through equity or through debt.
Yep.
Does that make sense?
Yep. Got it. Makes sense.
Cool. Okie dokes. Any other questions?
I do, but I don't know. It might be a little long. I don't know how complex is it explaining like levered and unlevered beta.
Levered and unlevered beta. So basically the idea of levered and unlevered beta is that, so beta is supposed to represent like the riskiness of your company, right? Like we'll just say beta is supposed to represent risk, right? So there's like the higher risk your company is, the more volatile it's going to be, right? Like if beta equals, so if beta equals 1, that means that it moves in line with the market, right? So if stock market goes up by 2%, your stock price is going to go up by 2%. Stock market goes down by 2%, your stock is going to go down by 2%, right? If there's another company that beta equals 2, that means that it's going to move twice as much. So if the stock goes up, stock market goes up by 1%, your stock price is going to go up by 2%. But if the stock market drops by 1%, your stock's going to drop by more than, it's going to drop by 2% also. So it's like twice the magnitude of everything, right? Moves at 2x the market, right? That's what beta is supposed to mean, right? So that's why it's like the more volatile it is, the riskier the company is, right? And so when you really look at this like risk concept, there's two types of risk. There's business model risk and there's capital structure risk. For every single company, there's two types of risk. What is business model risk? Business model risk is like, this is more like, hey, what type of business do you have, right? Like for example, a healthcare, a pharmaceutical company, or like a high tech, like a technology startup, is going to be a lot riskier than, I don't know, some boring old stodgy company that makes I don't know, sells paper.
Mm-hmm.
Okay. So that's business model risk, right? Cap structure risk is like capital structure is like, this is basically like how much debt.
Equity. Yeah. Okay.
Because the more debt you have, if you have too much debt, you could go bankrupt.
Mm-hmm.
Right? So what you're doing with like levered and unlevered beta is like, you want to first unlever your beta, or let me put it this way. You're first gonna go look at beta of your comps.
Mm-hmm.
Okay.
Yeah.
What are the betas of your comps? But the beta of your comps are both gonna include their business model risk
And their capital structure.
and the cap structure risk, right? However, their capital structure has nothing to do with you.
Mm-hmm.
If like your competitor has a lot of debt, does that make your company riskier? No, it doesn't, because that's not on your balance sheet.
Mm-hmm.
So when you unlever the beta, what you're doing is you're saying, okay, I want to take the average of my competitors' betas
Mm-hmm.
and apply that to myself, but I don't care about their cap structure risk.
Okay.
So I'm gonna like strip out
Okay.
the cap structure risk, and I'm only going to keep the business model risk, right? And I'm gonna take the average of all my competitors' business model risk. Now I have this average business model risk. Well, I have the same business model. That's why I'm a comp, right?
Mm-hmm.
So this does apply to me. And then now I need to layer on my own capital structure risk,
Okay.
right? And then so this is where you re-lever with your own capital structure.
Okay.
And now you get to the final beta or the new beta, and this is like my own beta, right? Does that make sense? So like conceptually, you're just saying the way you get the beta is by looking at your comps, but you want to remove their capital structure, keep the remainder, and then apply your own capital structure back.
Mm-hmm.
And now you're back to having both a business model risk and a cap structure risk, but it's with your own capital structure.
Okay.
Make sense?
Yeah. Perfect. Thank you. Okay.
Anything else?
No, that's really it.
Okay. All right. So yeah, I mean, like with DCF, you know, it's not hard, but it's the one part of the technical, like out of all the technical things you would have to study, it's the one that has kind of like the most variables, right? It's got like, you know, you gotta know how to calculate free cash flow. Within free cash flow, you know, you gotta know how to calculate like working capital, and that has its own calculation. You gotta know how to calculate terminal value. You gotta know how to calculate the discount rate, and with the discount rate, you gotta know how to calculate like WACC. You gotta know how to calculate cost of equity. Cost of equity has like its own variables like beta and all these other things. And so like that's why DCF questions are so popular, because there's so many different things they can ask you about, right? But like as long as you understand the concepts behind each of those variables, like the questions you're asking now, then it's actually not hard.
Yeah, for sure.
Cool. Okay, so if you don't have any questions, then we can wrap it up here, and then
Sounds good.
we'll talk again next week.
Okay. Thank you, Sam.
Alrighty, we'll talk soon. Bye.
Bye.
Thank you for tuning in. If you enjoyed the content, please subscribe to our channel or podcast so that you can get notified of all of our future episodes as well. If you'd like to apply to work with us so that we can help you in a similar way, feel free to reach out to our team at www.wallstreetmastermind.com/apply. The street is abbreviated to ST, so it's wallstmastermind.com/apply. Talk soon.